Welcome back to Accounting 101. In this video, we're going to talk Chapter 6, Inventories. So this is a continuation from what we learned in Chapter 5 with merchandising operations, but we're going to specifically talk about inventories, value in inventories, and the different cost flow methods, errors on the financial statements, and then the statement of presentation and analysis of inventories. So classifying inventory. If we look at the merchandising operations that we talked about in Chapter 5, they had one classification of inventory, merchandise inventory. So that's buying things that they're going to resell to the customers, so more retail type environments. If we look at a manufacturing company, they've got three classifications of inventories: raw materials, work in process, and finished goods. Briefly, what these are: raw materials are inventories, materials that they buy that they're going to then use in the manufacturing process to create a product to sell. Work in process is where they've started the process of creating the finished goods that they're going to sell, but they haven't completed it yet. And then finished goods is they have a product completed, the process is finished, and they're ready to sell to the customer. Regardless of the classifications, inventories are all reported as current assets on the balance sheet. So all these are lumped together as current assets. Let's look at Caterpillar here. This is example of their balance sheet, the inventory section. So they have raw materials, work in process, finished goods, and then other. So it's things that they either use in the manufacturing or use in their processes that doesn't fall into those three buckets. But that's an example of how you would report in a manufacturing environment. JIT, or just in time, can save a company a lot of money, but it isn't without risk. So Japanese companies really started this, and a lot of companies have implemented this. So it's just-in-time inventory, is that you're receiving the inventory just when you need it, so that you're not holding that inventory. Automotive suppliers are really good at doing this, where they're scheduling trucks to be delivered, that the inventory goes from the truck right into the production line, so that they're just continuing the production and being able to not hold that inventory, only get it when they need it. But the problem with that is, in this example, there was an earthquake that caused major damage to the company that produces 50% of the piston rings. The rings themselves are only $1.50 each, so not a big cost item, small piece that goes into making the engines, but you can't make an engine and car without them. So they were forced to shut down production for a few days. Tens of thousands of cars didn't get made as they were scheduled because of this. When we had the COVID-19 pandemic and the shutdowns around the world, it affected the supply chains. High-tech industry was hit the hardest: HP, Qualcomm, Samsung, other high-tech companies. They disrupted the supply chain, so they're just in time. They didn't have any safety stock. They didn't have any backup that they can continue production. According to Dell, the company is looking for alternative supply sources to deal with bottlenecks, experienced increased orders resulting from individuals working from home. So their demand went up, but their supply was suffering and they couldn't meet that demand. So this has led many companies to rethink their just-in-time approach. In a time of crisis, relying on the efficiency may not work, and they may need a more resilient form of inventory management. So what steps can companies take to avoid serious disruptions? In regard to the piston rings, they spread its manufacturing facilities across a few locations, so not just in one location. And then the put those far enough apart so a natural disaster won't be, make each of those facilities at risk at the same time. Automakers might consider becoming less dependent on a single supplier, as well as having weather contingency plans. So um, uh, different ways of doing that, having safety supply sit somewhere and then pulling from that supply to their manufacturing line, requiring their um, suppliers to maintain that safety supply, spreading their sourcing over more than one. So a lot of things to think about in managing accounting now, or managing inventories, not just the accounting side of it. The benefit from an accounting standpoint with not having inventories, you're not tying that up, and you're not having your working capital tied up with high inventory levels. But if you're really interested in this and wanting to, you should think about a career in supply chain. Supply chain management is a big kind of field that manages the inventories, but understanding what we're going to talk about today and how different levels of inventory affects the financial statements would be important part of doing that. Inventory quantities. So physical inventory, and we talked briefly about this in chapter 5 as well, is where you take a physical count of inventory. Why would we do this? Remember, we talked about the two systems in chapter 5, perpetual system and the periodic system. So under perpetual system, we're going to check the accuracy of inventory records and determine the amount of inventory lost due to shrinkage, wasted raw material, shoplifting, employee theft. And from the other side, also if you're making sure you have counted for everything correctly, for example, returns, that type of thing. If you're in a periodic system, you need to determine the inventory on hand because, again, we're not accounting for the inventory movements with each transaction. So we need to determine what the inventory is on hand at the end of the period and determine the cost of goods sold for that period. So a true periodic system, you don't know that until the end of the period when you do the physical inventory count. Taking a physical inventory involves counting, weighing, or measuring each kind of inventory on hand. Companies often, quote unquote, take inventory when the business is closed or business is slow at the end of the accounting period. Now you can do it and not at the end of the accounting period, but then there's just more work on the accountants to do what we call a roll forward, or we're bridging from the time you took the inventory to the next accounting period. A lot of times also when a company does this at least annually, the external auditors will be on site. They will do their own counts of certain things, do some testing, just watch the process. So the company I work for, my factory, we're actually going to take our physical inventory for finished goods on November 7th and 8th. So it's a kind of a 2-day process. We'll start it late in the afternoon of the 7th on Friday, and then we're going to shut down production and shipping on Saturday and take the physical inventory count. It's going to take most of the day on Saturday, so we'll have people starting early in the morning, 6 or 7 a.m., and we're hoping to wrap up by 3 or 4 p.m. But if it doesn't go smoothly, we'll have to continue that until we complete the full count. Taking inventories, there's a lot of opportunities for fraud in taking inventories. So one, a salad oil company filled its storage tanks mostly with water. Oil floats on top of water, so the oil floated to the top. Auditors thought it was full of oil. They also said they had more tanks than it really did. They repainted numbers on the tanks to confuse the auditor. So when they're driving around from tank to tank and counting, trying to cause some confusion. So that is very much fraud, not an error or anything. It's unethical. And since we're talking about it, they got caught at it at some point. One thing they do with liquids, special oils, They can put a false bottom in a tank also. And what they do to measure it is they'll take a stick and drop it to the bottom of the tank to make sure that the depth of the tank is what it appears on the outside. When you pull the tank out, it's going to be coated with oil because that's what's on top. So it looks like it's full of oil even though there's water. So there's a lot of things that companies can do if they want to perpetrate the fraud. It's interesting and it's good to know about that so you know not what not to do, and as an accountant you can make sure things are done correctly. We talked in Chapter 5 again about determining ownership, and what we didn't talk about is accounting for that, so the goods in transit. So it's purchased goods not yet received or sold goods not yet delivered. Goods in transit should be included in the inventory of the company that has legal title to the goods, and legal title is determined by the terms of sale. So let's review what these are: FOB shipping point and FOB destination. So at shipping point, the buyer pays for the freight costs, and the ownership passes to the buyer when loaded on the truck. So the buyer owns it once it's on the truck and is in transit to the buyer. FOB destination is the opposite. The seller is going to pay for and arrange for shipping to the buyer. So the ownership passes to the buyer upon delivery. So an FOB shipping point, it's the buyer's inventory as soon as it's put on a truck and sent. So if that hasn't been delivered at the end of the period, the buyer has to include that in their inventory. The seller will not include it in their inventory. FOB destination, it's the seller's inventory until it gets delivered to the buyer. So at the end of the period, if it's still in transit, the seller will account for that in their inventory. The buyer will not. So review question: goods in transit should be included in the inventory of the buyer when public carrier accepts the goods from the seller, goods reach the buyer, terms of sale or FOB destination, in terms of sale or FOB shipping point. So which ones of these in transit should the buyer include? It's when the terms of sale are FOB shipping point. Now if you thought A, the public carrier accepts the goods from the seller, that is true, but only if the terms of sale are FOB shipping point. So the terms of sale dictate when it should be included in the inventory of the buyer, not the fact that it's on a public carrier, because if it's FOB destination, it could be on a public carrier and it's on the seller's books. Consigned goods. This is where one party holds inventory and tries to sell it for another party. They charge a fee for that, but they don't take ownership of the goods. Okay. Car, boats, antique dealers sell goods on consignment to avoid risk of purchasing an item that they won't be able to sell later. Okay, so the original seller of the goods are the owners, where it's sitting in a warehouse or in a showroom, and a company trying to sell that goods, they're not taking ownership. It's back to the original seller as well. Okay, so if you are holding consigned inventory, you don't count that into your inventory. Here's another fraud example. Ted Nickerson, CEO of a clock manufacturer, Daly Industries, had expensive tastes. To support this habit, Ted took out large loans which he collateralized with the shares of Daly Industries stock. That is a common practice where executives get paid by stock, or they hold a lot of stock options and not get paid in cash necessarily. They can use that as collateral and borrow against that. So that in itself isn't a fraud. But what happens is if the stock price falls, he'd either have to put up more shares to the bank or pay off some of the loans to make the agreed ratios back in line. So to achieve the target net income, and maintain the stock price, Ted coerced employees of the company to alter inventory figures. Inventory quantities were manipulated, so they changed the amounts of the inventory. So if a tag said there were 20 units of an item, they changed that tag to 220, so it shows that they had more inventory than they had. Unit costs could change. So if the ending inventory value per unit was 125, they could change that to 1,250. So both of these fraudulent changes had the effect of increasing the amount of reported inventory, which then, and we will learn how this happens and go through examples, reduce the cost of goods sold. With a lower cost of goods sold, you have a higher net income, which is going to cause the stock price to be maintained or increase. So $245,000 total take in this example. The control that was missing was the independent internal verification. The company should have spot checked its inventory records periodically, verifying that the number of units in the records agreed with the amount and the unit cost agreed with the vendor price sheets. And that is someone different than that has responsibilities of maintaining the inventory records and performing the inventory counts. So let's look at the rules of ownership and how it affects our inventory. Has-been company completed its inventory count. It arrived at a total inventory value of $200,000. You have been given the information listed here. Discuss how this information affects the reported cost of inventory. So first, has been included in the inventory goods held on consignment for Falls Company costing $15,000. So part of the $200,000 value they came up with included the $15,000 of inventory held on consignment. The company did not include in the count purchased goods of $10,000 that were in transit. The terms were FOB shipping point. And the company did not include in the count sold inventory with a cost of $12,000, which was in transit, terms FOB shipping point. So we need to determine each of these items. Does that have any effect on the reported cost of inventory, the $200,000? So first, goods held on consignment. This should be deducted from the inventory count. So even though it's physically sitting in our location, in our warehouse, in our showroom, and we can physically count it and see it, it's not our inventory. It's held on consignment. We don't own that inventory, so we shouldn't have included that in our inventory count. So we should not have included that. The second one, goods purchased FOB shipping point. We're the purchaser, we're the buyer. FOB shipping point, we take legal title of that inventory when it's in transit. So if it's in transit to us at the time of the inventory count, we should have included it. We need to add that to our inventory count. And the last item, it was treated correctly. So that was where we sold goods, FOB shipping point. It wasn't delivered to the buyer at the time we took inventory, but since the title changes when we ship it, since it's in transit, it's the buyer's inventory, not our inventory. We shouldn't have counted that, which we did not. So it was treated correctly. So making these adjustments, we had the $200,000 that we started with. We should subtract the $15,000 from the consignment because that's not ours, but we need to add $10,000 for the goods purchased FOB shipping point. So our inventory should be $195,000, not the $200,000. So you'll have homework problems that go through these types of examples, and you need to determine what to include in the inventory count and what to exclude. Now we'll talk about cost flow methods and what the financial effects are. Inventory is accounted for at cost. Cost includes all expenditures necessary to acquire goods and place them in a condition ready for sale. Okay, we saw this a little bit in Chapter 5 when we talked about adding the cost of shipping into inventory. So remember, when it's FOB shipping point on the goods that we buy. We're going to pay for the shipping, so we're going to debit inventory, credit cash when we pay for that shipment. So it's included in the cost of the inventory. So freight is just an example. There's other costs possibly that we have to take into account to get the goods in a condition ready for sale. Unit costs are applied to quantities to compute the total cost of the inventory and the cost of goods sold using 4 methods. So there's 4 methods that we're going to talk about. Specific identification, first in, first out, or FIFO, last in, first out, LIFO, or average cost. The last 3, FIFO, LIFO, and average cost, are all cost flow assumptions, which means that we're making an assumption on the cost flow that doesn't match the physical flow of the inventory. So we'll look first at specific identification. Crit's TV company purchases 3 identical 50-inch TVs on different dates, a cost of $700, $750, and $800. During the year, Crivet sold 2 sets at $1,200 each, and we have a table that summarizes that. So we have our 3 purchases, we have 1 sale, 2 TVs. Now we'll look at how do we account for that inventory. So if Crivet sold the TVs it purchased on February 3rd and May 22nd, its cost of goods sold is $1,500. We achieved that by looking at the purchase on those 2 dates. One was for $700, the May 22nd was $800. Ending inventory is going to be $750, which is the item that we purchased second and didn't sell. Okay, so if we flip back, we look at February 3rd, we bought a TV at $700. March 5th, we bought a TV at $750. May 22nd, we bought a TV at $800. So specific identification, we track which ones were sold at what time. So we had 2 sales, or sale of 2 TVs on the 1st. We sold the first one purchased. We sold the last one purchased. So we can identify specifically what each of those cost us. That is our cost of goods sold. Whatever's left, that purchase that we made second, is in our ending inventory valued at $750. So we're specifically identifying those. So this is an actual physical flow costing method, which means our costing matches our physical flow. So we're matching the cost to an item, and when that flows out physically, we're going to take the cost with it. Items still in inventory are specifically costed to arrive at the total cost of ending inventory. So this practice is relatively rare. There's a lot of bookkeeping that needs to happen, a lot of keeping track of specific items. Most companies make assumptions, cost flow assumptions, about which units were sold, and we'll go through those examples. Okay, this is really done, again, if you think about maybe rare vehicles or antiques, so low volume items, high value, you want to specifically track that cost. So the major disadvantage is that management may be able to manipulate net income, can boost net income by selling units purchased at a low cost, or reduce net income by selling units purchased at a high cost. So throughout the period when they make a sale, if it's identical things like the same TV model, but at different costing, they can manipulate the results by picking which ones they choose using specific identification, whereas a cost flow assumption, it wouldn't matter which physical item was sold because they're all going to be costed the same. So here's data. We're going to use this to talk about the cost flow methods or cost flow assumptions and the different methods. This is for Houston Electronics Astro condensers. Remember the formula we talked about in Chapter 5. You're going to be tired of hearing this formula as we go through the rest of this chapter. Beginning inventory plus cost of goods purchased is going to equal our cost of goods available. We subtract ending inventory from cost of goods available and we get cost of goods sold. So here's the purchases that happen starting with our beginning inventory. On January 1st, we had 100 units at $10. We had purchases on April 15th, 200 units at $11. August 4th, 300 units at $12 per unit. And November 27th, we purchased 400 units at $13. Okay. So we add those up. We have 1,000 units available for sale at a total cost of $12,000. So that's our available for sale, both units and dollars. We sold 4,050 units, or we had an ending inventory, I'm sorry. Ending inventory is 450 units. We subtract that from what's available, and we determine that we sold 550 units. Okay, so that's the flow of the units. Now we'll talk about how we can attribute cost to those ending inventory and units sold using the three different methods. First in, first out, or FIFO. Cost of the earliest good purchased are the first to be recognized in determining cost of goods sold. Okay, so the first units purchased are the first units sold. It often parallels actual physical flow of merchandise. That makes sense. If you buy something on April 15th and you make a sale but you made a sale in March before you made those purchases, you're going to physically take it out of your beginning inventory. Okay, that's logical, that makes sense. The costing, this cost flow assumption mirrors that, but unlike specific identification, we're not specifically putting those costs. We're just making the assumption and doing the calculation. Companies determine the cost of the ending inventory by taking the unit cost in the most recent purchase and working backward until all units of inventory have been costed. Okay, so let's think about this again and talk about this again. Cost of the ending inventory, you take the unit cost of the most recent purchase, so the last purchase you made, you're going to assign those costs to the units in ending inventory, and you're going to continue working backwards through the different layers of purchases until all inventory has been costed. And we'll see how that works using this data that we just talked about. So we have 1,000 units available, total cost of $12,000. Okay, that is going to be the same in all three of these that we're going to talk about, the FIFO, LIFO, and average cost. It's when you get into ending inventory and cost of goods sold, what's different. So we said that we had 450 units in ending inventory. Okay, so to cost those, we're going to look at the last purchase, which was November 27th. We purchased 400 units at $13, $5,200. Since our ending inventory is more than that, we're going to include all 400 of those units at that $13 cost in our ending inventory. We have 450, so we have 50 more units that we have to cost. What is the cost of those 50 units? We look at the previous purchase, August 24th. We purchased 300, so we purchased more than the 50 that we're trying to cost. So we're going to take that 50 all at that purchase price of $12 per unit. So 50 units at $12 is $600. Our total in inventory is 450 units at $5,800. So to get cost of goods sold, we take our cost of goods available, $12,000, less our ending inventory that we just costed out, $5,800. Our cost of goods sold is $6,200. So here's another example. We've got those charts we just talked about, and down at the bottom, kind of a visual. We had the $1,000 on top there as our beginning inventory. The $2,200 is our first purchase. Our second purchase, 300 units at $12, is $3,600. So we've got two boxes there that represent that. 3,000 of that is in our cost of goods sold. 600, the 50 units, is in our ending inventory, and our last purchase, 400 units at $13, the 5,200 is in our ending inventory. So we're splitting our beginning inventory and purchases between cost of goods sold and ending inventory. So the first items, beginning inventory, and our first purchases are in cost of goods sold, FIFO. That's what that stands for. If you want to think about it the other way, the ending inventory is the LISH assumption, last in, still here. Okay, so the last purchases are what's still in inventory. So if that helps you think about it, making that conversion from FIFO to LISH, that's what we're doing. But remember, it's a cost of goods sold assumption, so FIFO is first in, first out into cost of goods sold. So let's look at this again. Counting records of Shumway Ag implements shows the following data. We had 4,000 units at $3 in beginning inventory. We purchased 6,000 units at $4. We sold 7,000 units at $12. What is the cost of goods sold during the period using FIFO? So the first in is the first out. Okay. So what is our cost of goods available for sale? Beginning inventory, 4,000 at $3, purchase of 6,000 at $4, $36,000 is our cost of goods available. What's our ending inventory? Well, you have 10,000 units available. We sold 3,000, so we have 3,000 units available. Our cost of goods sold, we're going to take our cost of goods available minus our ending inventory. So cost of goods available is the 36,000 that we calculated. Our ending inventory under FIFO is 3,000 units at the last purchase. In this case, we only had one purchase, so $4. $4 times 3,000 is 24,000. Since we purchased 6,000, was more than our 3,000 of ending inventory, we don't have to worry about the beginning inventory cost in our ending inventory because we sold those through. Our cost of goods sold is $2,000 or $24,000. Another way we could have done this is just costed out our cost of goods sold directly. So we know we sold 7,000 units. So we sold all of our beginning inventory, so 4,000 at $3. We sold 3,000 of the 6,000 units purchased at $4, so 3,000 at 4, 4,000 at 3. That would have given us our $24,000 of cost of goods sold. So that's another way you can work through this as well. Now let's talk about last in, first out, LIFO. The cost of the latest goods purchased are the first to be sold. It seldom coincides with the actual physical flow of inventory. Okay, if you think about this, we're going to cost our first unit sold at the cost of our last units purchased. So if we make a sale in January and we make our last purchase in December, cost of goods sold for the year says that the cost of that last purchased, that last in, is the cost that we assign to our first goods purchased or first goods sold, which was in January, we physically cannot sell in January goods that we're going to buy in the following December. Physically, we can't do that, so it doesn't match our physical flow. Okay, so that's what that means. Now, if you think about bulk items, sand, salt, some other things that where you are going to dump it into a pile, and then when you use it up, you take it off the top of the pile, that's a last in, first out physical flow. Okay, so that's just an example of there are some inventory where physical flow is last in, first out. Okay, but it's rare, it's more rare, and the last in, first out LIFO cost flow assumption is rare to match the physical flow. Now again, we'll look at the data for Houston Electronics. When we talk about LIFO, formula is the same. Beginning inventory plus cost of goods purchased is our cost of goods available minus our ending inventory is our cost of goods sold. Again, we have our beginning inventory in our purchases, same number of units available for sale that we saw when we looked at this data for FIFO, same cost of goods available, the $12,000. Our ending inventory is 450 units, and we sold 550 units. Okay, so we're going to use the same data, but now we're going to apply the LIFO example instead of the FIFO example. So again, our cost of goods available for sale are the same that we saw before using FIFO. So our number of units at the different unit cost, beginning inventory plus all our purchases. Now our ending inventory is the same number of units, 450, but using last in, first out means that the last purchases are the first ones in cost of goods sold. Our ending inventory is going to be our beginning inventory and our first purchases. So we're going to start with the beginning inventory, 100 units at $10 for $1,000. We have to get to 450, remember, so we have 100. The next purchase was for 200 units. So we're going to use all 200 units at $11. 2,200 is our cost. And we need 150 units left because we have 300 accounted for. We need to get to 450, so we use 150 units from our August 24th purchase at $12 per unit. So 150 times 12 is $1,800 cost. That's our 450 units in our ending inventory. Total cost is $5,000. Once we have our cost of ending inventory, we can calculate cost of goods sold. $12,000 available minus $5,000 ending inventory. Our cost of goods sold is $7,000. And again, we have a different visual representation. The charts at the top left there, what we just went through. And then if you look at the bottom there, we're looking at the different layers of inventory, our beginning inventory, our first purchase, our second purchase on August 24th is split again, and then our third purchase, and where those go, either ending inventory or cost of goods sold. So a good visual representation of that. And again, another way of thinking LIFO, since LIFO is a cost of goods sold flow, if you think about ending inventory, it's fish, first in, still here. So the beginning inventory in this example, 100 units, is still in our ending inventory. Okay, and again, it's a cost flow assumption, not a physical flow. So again, we'll look at Shumway Ag Implements. Beginning inventory of 4,000 units at $3, purchases 6,000 units at $4, sales 7,000 units at $12. Determine the cost of goods sold during the period under a periodic inventory system using the LIFO method. We'll start again with cost of goods available for sale. This is the same in all methods. 4,000 units beginning inventory at $3 plus 6,000 units purchased at $4. $36,000 cost of goods available for sale. Ending inventory in units, 10,000. So 4,000 beginning plus 6,000 purchases. There's a 10,000 available minus our 7,000 units sold. We have 3,000 units in ending inventory. Our cost of goods sold under LIFO is our cost of goods available, it's $36,000, minus our ending inventory, 3,000 units at $3 per unit. So that's from our beginning inventory. So that $9,000 gives us $27,000 cost of goods sold under LIFO. And our last cost flow assumption is average cost. This allocates the cost of goods available for sale on the basis of a weighted average unit cost. The weighted average unit cost is the average cost that is weighted by the number of units purchased at each unit cost. Applies the weighted average unit cost to the units on hand to determine the cost of ending inventory. We'll go back to the Houston Electronics data. Okay, same formula, beginning inventory plus cost of goods sold is our cost of goods available, minus our ending inventory is our cost of goods sold. We have the data at the bottom there, beginning inventory plus our 3 purchases, 1,000 units at $12,000 total cost, 450 units in ending inventory, and our units sold was 550 units. So let's look at how we cost this. Start with our cost of goods available, 1,000 units, $12,000. Our ending inventory, our 450 units, how do we cost that? Doing an average cost, we take the total cost, $12,000, so the total cost available, divided by our units available, 1,000 units. We have a weighted average unit cost of $12. So we take our 450 units ending inventory times our weighted average unit cost of $12. Total ending inventory cost is $5,400. Cost of goods available is $12,000 less ending inventory of $5,400. Cost of goods sold is $6,600. Now when you're doing your homework and the exams, sometimes your unit cost will not come out to a whole dollar like this. You're going to have some cents associated with it. Just be aware of how many decimals they want you to round to. So sometimes they may say, 3 decimals on the average cost, or 4, 2, whatever. Just be aware of that, because that could change or will change your answer if you're not using the right number of decimals, or the decimals that they want you to use in the problem. So just be aware of that. So here's a graphical example. Weighted average unit cost is the cost of goods available times the units available, $12 per unit. We're going to apply that $12 to both our units on hand for ending inventory, so 450 times the 12, and our cost of goods sold, 550 units sold at $12, 6,600. It's also cost of goods available, 12,000 minus ending 5,400 is our 6,600. So either way, you can calculate the cost of goods sold that way. And again, we'll look at Shumway Ag, that same data we've seen before. Now we're going to use the average cost method. So we take our cost of goods available for sale, $36,000, 10,000 units. We've seen that before. Ending inventory, 10,000 available minus 7,000 sold is 3,000. Now we get our weighted average unit cost. So we take our cost of goods available to 36,000, and it shows again how we arrived at that 36,000 divided by the 10,000 units available. $3.60 is our weighted average unit cost. We apply that to our ending inventory of 3,000 units. So 3,000 times 360. Cost of goods available, 36,000 minus 3,000 times 360. gives us our 25,200 cost of goods sold. Which companies or how many companies use which method? So the major U.S. companies, 45%, almost half, are using FIFO. A quarter, 24%, are using LIFO. 16% use average cost, and only 15% use something different, whether that's specific identification or some other cost flow assumption that is acceptable under GAAP. There are more. We're just covering these four, in this class. So LIFO, FIFO, average cost, and specific identification. But just be aware there's other methods that a few companies, but not very many, are using. Financial statement and tax effects of cost flow methods. Each of the three cost flow methods is acceptable under GAAP. So FIFO, LIFO, average cost. Under Armour and Amazon currently use FIFO. Target uses LIFO. Starbucks and Microsoft use average cost. Walmart uses LIFO for domestic inventories and FIFO for foreign inventories. Okay, so if you're comparing Target and Walmart, if you look at the total company, you're going to get some differences because of cost flow methods, because Walmart is using FIFO for foreign, LIFO for domestic, where Target just uses LIFO everywhere. Okay, so to the extent that Walmart has stuff outside of the U.S., their inventory costing is going to be different than their U.S. So if we look at Houston Electronics again, comparing the different methods that we went through. If you look down the left side, the cost of goods available, under all three methods, they're the same. 1,000 units available at $12,000. Our ending inventory and cost of goods sold is where it differs. So under FIFO, we had $5,800 of ending inventory, $6,200 cost of goods sold. LIFO, even though the units are the same, the cost is different. We had $5,000 in ending inventory, so a lower ending inventory. Cost of goods sold, same 550 units, but a higher cost of goods sold, $7,000. Average cost, again, 450 units ending inventory, $5,400 based on average cost. Cost of goods sold, it's 550 units at $6,600. You see that average cost falls in between FIFO and LIFO as far as ending inventory and cost of goods sold, because we're using an average method. Now if we look at income statement effects, we have our revenue minus cost of goods sold is gross profit, minus operating expenses, minus income taxes, because this is our net income. So we have in the middle here, to calculate cost of goods sold, our beginning plus purchases is what's our cost of goods available, minus ending gives our cost of goods sold. So under FIFO, our net income is $2,640. Under LIFO, our net income is lower at $2,000. Average cost, it's in between again, $2,320. So you can see that higher ending inventory is going to give you a lower cost of goods sold, which gives you a higher net income. Major advantage to the FIFO method is that during a period of inflation, the cost allocated to ending inventory will approximate their current cost. So that's an advantage. LIFO, period of inflation, the cost allocated to inventory may be significantly understated in terms of current cost. So if we still have beginning inventory at a much lower cost, our ending inventory is at a lower cost under LIFO. So our balance sheet is going to have a lower inventory, and it could be understating our current cost. Tax effects. Both inventory and net income are higher when companies use FIFO during a period of inflation. LIFO results in the lowest income tax because of the lower income before taxes during times of rising costs. A tax rule, often referred to as the LIFO conformity rule, requires that if companies use LIFO for tax purposes, they must also use it for financial reporting purposes. So a company cannot say, oh, we're going to use LIFO for tax only because that's going to show lower income taxes and it results in lower income taxes that we have to pay. If they do that for tax purposes, they'll have to do it for financial reporting purposes as well, so those match. The method used for inventory costing should be consistent from one accounting period to another. That's the consistency concept. It enables comparability between periods. Although consistency is preferred, a company may change inventory costing method. Changes and effects on net income should be disclosed in the financial statements. So here's a General Electric, a note from their financial statements saying that they were measuring inventory on a LIFO basis. They changed to FIFO, saying that they think that FIFO is preferable measure for inventories. It better reflects the current value inventory reported on their balance sheet, and it improves matching cost of goods sold with the related revenue. So they made the change, they disclosed it. What they also had to do with their financial statements is restate prior years as if they would have had FIFO in previous years. So when they report with the FIFO method in their first year, they go back and restate. So those are not going to match what they reported in previous years because they're showing that impact in prior years. So the cost flow method that often parallels the actual physical flow of merchandise is FIFO, LIFO, average cost, or gross profit method. So which most matches physical flow. In most cases, it's going to be FIFO. First in, first out. So the first things you buy is the first things that are in cost of goods sold. In a period of inflation, the cost flow method that results in the lowest income taxes, FIFO, LIFO, average cost, or gross profit method. And the answer is LIFO, because that's going to give you the highest cost of goods sold, which is lower gross profit, lower income, which makes lower taxes. Is LIFO fair? So ExxonMobil, like many U.S. companies, uses LIFO to value its inventory for financial reporting and tax purposes. One recent year, this resulted in a cost of goods sold figure that was $5.6 billion higher than if they were to use FIFO. Since their cost of goods sold was higher, it reduces net income, which reduces taxes. Critics say that LIFO provides an unfair tax dodge. Well, it can't be a dodge if it's a legal way of reporting and valuing inventory for tax purposes. So Congress may look for more sources of tax revenue. Some lawmakers favor the elimination of LIFO. So then if they eliminate that and a company still use it, it would be a tax dodge because it's illegal. But since it's still part of the tax code, it's still legal. It's not really a dodge. It's just using the tax code to their benefit. Supporters of LIFO, however, argue that the method is conceptually sound because it matches current costs with current revenues. In addition, they point out matching provides protection against inflation. International accounting standards do not allow the use of LIFO. Because of this, net income of foreign oil companies, BP and Royal Dutch Shell, cannot be directly comparable to U.S. companies which make the analysis difficult. So you be aware that different accounting methods under IFRS, the International Financial Reporting Standards, and GAAP. If they use LIFO under GAAP, they can't use it in IFRS. So when you're comparing companies using those different ones, you're going to have a difference. Okay. So is LIFO fair? Arguments for the use and against LIFO. Again, proponents say that LIFO is conceptually superior because it matches most recent cost with the most recent selling price. Critics say that it artificially understates the company net income and consequently reduces tax payments. Because most foreign companies aren't allowed to use LIFO, it's used by U.S. companies, reduces the ability of investors to compare U.S. companies with foreign companies. Okay, so you can make your own decision and thoughts of, do you think it's fair or not? But again, in the U.S., it's legal. They're not doing anything wrong. They're just using a cost flow method that they think is most advantageous to them. So we'll look at some data here for London Company. Sold 600 units of inventory in April. Their beginning inventory was 250 units at $10. They purchased April 15th 400 units at $12, and April 23rd 350 units at $13. So they had 1,000 units available to sell at a cost of $11,850. And we need to determine the cost of goods sold during the period under a periodic inventory system using FIFO, LIFO, and average cost. Okay. So again, cost of goods available, $11,850, 1,000 units. Our ending inventory is 1,000 units available minus our sales of 600 units that was given in the problem, so 400 units are in our ending inventory. Under FIFO, we take the cost of goods available, $11,850, minus our $4,500, which is our 350 units in inventory at $13 from our April 23rd purchase. And then we subtract $600, which is 50 more units to get to the 400 units in inventory at $12 from the April 15th purchase. So our cost of goods available minus our ending inventory is our cost of goods sold, $6,700. What would cost of goods sold be under LIFO? Last in or the first out. So our ending inventory is made up of our beginning inventory, so the 250 units, plus another 150 units to get to 400 units. So 250 at 10, 150 at 12. Our cost of goods available, 11,850, minus our ending inventory is 7,550 cost of goods sold. Now weighted average, or average costing, we got to get the average cost per unit. So we take our 11,850 cost of goods available divided by 1,000 units available to get our weighted average cost per unit, $11.85. We can apply that to our ending inventory and our number of units purchased. So in this case, we're going to apply it to ending inventory of 400 units times the 1185. We're going to subtract that from our cost of goods available, 11,850, and we get $7,110 of cost of goods sold using average cost. So again, using the same data, we can calculate the three different cost flows. In all cases, our cost of goods available is the same. Our units available is the same. Our units in ending inventory is the same. Our units sold is the same. The only difference that we're doing is which cost do we apply to ending inventory and to cost of goods sold. Indicate the effects of inventory errors on the financial statements. So common causes of errors: failure to count or price inventory correctly, not properly recognizing the transfer of legal title to goods in transit, and errors affect both the income statement and the balance sheet. So if we make an error in our inventory count or our inventory valuation, it's going to affect the balance sheet and also affect the income statement. Inventory errors affect the computation of both cost of goods sold and net income in two periods. Okay, and we'll talk about what that means. So again, our formula: beginning inventory plus cost of goods sold, or I'm sorry, beginning inventory plus cost of goods purchased is cost of goods available, minus ending inventory is cost of goods sold. Okay, that same formula that we've seen throughout this chapter. So if the inventory error is an understatement in beginning inventory, so our beginning inventory is too low, our cost of goods sold is going to be understated, our net income will be overstated. If our beginning inventory is overstated, our cost of goods sold will be overstated, our net income will be understated. If the error is in our ending inventory and we understate our ending inventory, our cost of goods sold will be overstated, net income will be understated. If the error in ending inventory is that we overstated ending inventory, our cost of goods sold will be understated, our net income will be overstated. This is a great chart to keep handy and to help study, and if you're going through some of the homework assignments, having this chart available to remember what errors due to the cost of goods sold and net income. Now, we said that it affects two periods of cost of goods sold and net income. Okay, and error in ending inventory of the current period will have a reverse effect on net income of the next accounting period. That's because our ending inventory in period one becomes our beginning inventory the next period. So if it's wrong in the first period, it'll be wrong. The beginning inventory will be wrong in the second period, but it's going to have the opposite. So over the 2 years, total net income is correct. Cumulative, because the errors offset each other, and it self-corrects on the balance sheet as well. Correctness of ending inventory depends entirely on the accuracy of taking and costing the inventory. Let's look at how that works. So here's some income statement for two periods, 2026 and 2027. The yellow shaded is the incorrect, the whites section is the correct. So in this case, in 2026, our ending inventory we had as 12,000. It should have been 15,000. So we understated our ending inventory, which means that our net income was understated because our cost of goods sold was overstated. Okay. If everything else is correct, in the next year, the 2027, our beginning inventory is understated because our ending inventory from the prior year was understated, so that error carries over. That means that in 2027, the second year, our cost of goods sold was understated, which means our net income was overstated. In total, for the 2 years, under the incorrect way and the correct way, our net income was 35,000 in both cases, so the errors cancel each other out in a 2-year period. It's still wrong, but it self-corrected itself. Okay. Review question. Understating ending inventory will overstate assets, cost of goods sold, net income, or stockholders' equity. So understating in an inventory, what's the impact? It's an overstatement of cost of goods sold. Okay. Assets, net income, and stockholders' equities all will be wrong as well, but the overstatement will be in cost of goods sold. And if we look at the balance sheet effects, inventory errors on the balance sheet, remember the basic accounting equation, assets equal liabilities plus stockholders' equity. So if ending inventory is overstated, that means our assets are overstated. Inventory is a current asset, so assets are going to be overstated. There's no effect on liabilities, but our stockholders' equity will be overstated as well because our net income is understated. If the error in ending inventory is an understatement, so our inventory is understated, our assets will be understated, no effect on liabilities, and stockholders' equity will be understated. Let's do an example. Visual company overstated its 2026 ending inventory by $22,000. Determine the impact of this error has on ending inventory, cost of goods sold, stockholders' equity in 2026 and 2027. So in 2026, ending inventory is overstated, so our ending inventory is overstated. Simple. How does it impact cost of goods sold? Well, first let's go to 2027. Ending inventory in 2026 is overstated. 2027, there's no effect on ending inventory based on that error. Okay. Cost of goods sold is understated in 2026 by the $22,000. What happens in 2027? Our cost of goods sold will be overstated. Understated one year, overstated the next year. And our stockholders' equity, it's overstated in 2026 by $22,000. 2027, there's no effect. So income statement is wrong in both years. Balance sheet is wrong in 2026, but it's self-corrected and it's correct in 2027. In our last learning objective, explain the statement, presentation, and analysis of inventory. Presentation. Balance sheet. The inventory is classified as a current asset. So whether it's merchandise inventory that we saw in Chapter 5 or raw materials, work in process, finished goods that we learned in this chapter, it's all current assets. In the income statement, cost of goods sold is subtracted from sales. Okay, we saw that before, so no change there. When we look at the multi-step income statement, sales minus cost of goods sold is gross profit. But there also should be disclosures of the major inventory classifications. So we may have a condensed balance sheet where we just say inventories on the face of the balance sheet. We will then need a note or another schedule that shows the different classifications. We need to disclose the basis of accounting, cost or lower of cost, or lower of cost or net realizable value, and we'll get into that next. And the cost method, FIFO, LIFO, or average cost. So those all need to be disclosed in the financial statements. The lower of cost or net realizable value. When the value of inventory is lower than its cost, companies must write down the inventory to its net realizable value. The net realizable value is the net amount that a company expects to realize or receive from the sale of inventory. And this is an example of accounting conservatism. So we're being conservative, writing down our inventory when we don't think we can realize more than what the cost is. So here's an example. Kentucky Electronics has the following lines of merchandise with costs and net realizable values as indicated. So different types of inventories: flat screen TVs, wireless speakers, Bluetooth headphones, smartwatches, smartwatch accessories. We have a total inventory. We have the number of units in each, We have the cost per unit of each and the net realizable value per each. We look at each segment or category of inventory and apply the net lower of cost or net realizable value to each individually. So flat screen TVs, our cost is 600. The net realizable value is 550. The net realizable value is lower, so we take the 550 times the 100 units. So our value, we should value that inventory at 55,000. The wireless speakers, the cost is 90. We think we can sell it for 104. So the cost is lower, so we keep it on our books at cost, 90 units if, or $90 cost at 500 units. Bluetooth headphones, the cost is 50. We think we can only sell them for 48. Maybe a new model has come out, so the model we have to discount. So we take the lower of the two, in this case the net realizable value, times the number of units, 850, to get our inventory value of 40,800. And smartwatch accessories, we have 3,000 units. Our cost is 5. We can sell it for 6, so our net realizable value is 6. We value it at cost, $5 times 3,000, 15,000. Add those up, our total inventory is 155,800. So let's do an example. Tracy Company sells 3 different types of home heating stoves, gas, wood, and pellet. The cost and net realizable value of its inventory of stoves are as follows. Gas, the cost is 84,000, net realizable value is 79,000. Wood, cost is 250, net realizable value is 280. Pellet, cost is 112, net realizable value is 101,000. Determine the value of the company's inventory under the lower cost or net realizable value approach. So we take the lowest of the two for each category. So in gas, it's a 79,000. The wood, the lower is the cost, 250,000. The pellet, the lower is the net realizable value, 101,000. Add those 3 up, the total inventory is $430,000. Financial analysis and data analytics. Managing inventory levels is a critical task. If we have high inventory levels, we may incur high carrying costs. So investment in the inventory, we'll have storage. We may have to rent more space to store the goods. We have insurance on those goods. We have the risk of obsolescence. So if we have an item that's going to be obsolete soon, we may run the risk of having to write down our inventory, and we run the risk of damage. Okay. If we have low inventory levels, it may lead to stockouts and lost sales where we aren't able to fulfill a customer's demand if we don't have the inventory to do that. Here's some analysis that we do on inventories. We can look at inventory turnover, which measures the number of times on average the inventory is sold during the period. And we look at the days in inventory, which measures the average number of days inventory is held. How do we calculate these? Inventory turnover is the cost of goods sold divided by the average inventory. And the days in inventory is 365. It's the number of days in a year divided by the inventory turnover. So let's look at Walmart as an example. Our inventory turnover. So we take our cost of goods sold, $394,605 million, so $394 billion of cost of goods sold, divided by the average inventory. We take a simple average, our beginning inventory plus our ending inventory divided by 2. So in this example, our inventory turnover is 8.9 times. So we turn our inventory over almost 9 times a year. Okay. The target that they had, or target business, not the target that Walmart had 5.9 inventory turnover. So they're turning their inventory slower than Walmart is. The number of days in inventory. So for Walmart, we take the 365 divided by our inventory turnover of 8.9. So they're holding 41 days of inventory on hand on average. So it'll take them 41 days to sell their inventory. Whereas Target, the lower turnover, they're going to have more days in inventory. So 61.9 days in inventory. So Target is holding inventory longer, turning it slower. So we'll look at examples, too many TVs or too few. So Sony company makes electronics. These are a high risk of obsolescence and economic swings on the electronic front. So some analysts following Sony expressed concern because the company built up its inventory of television in an attempt to sell 25 million LCD TVs, more than the prior year, so a 60% increase over the prior year. So Sony had a goal to sell more TVs. They increased their inventory to hopefully support that higher demand. A year earlier, Sony had cut its inventory levels, so its quarterly days in inventory was down to 38 days compared to 61 days for the same quarter year before that. But then the following year, they built up their inventory and had 59 days of inventory. So they went from 61 down to 38 and then built it back up to 59. Management said it didn't think Sony's inventory levels were too high, but analysts were concerned because the company may have to engage in heavy discounting in order to sell off its inventory. Analysts noted that the losses from discounting can be punishing. So what are the advantages and disadvantages of having a low days inventory measure? If it had low days in inventory, it reduces the amount of cash it has tied up, minimizes the risk that will be stuck with excess inventory and could be forced to have big discounts. They also face the risk that TVs may become obsolete. So if they have low inventory, they reduce that risk. However, low inventories increases the risk that will encounter stockouts and not have adequate inventory to meet customer demand. So again, we talked about inventory management a couple times. This is an example of trying to kind of manage what's the right level to have. Do you increase the inventory so you can meet demand? You run the risk of obsolescence or damage. You can have cost tied up. If you have too low, you may not be able to make the sales. So data analytics, inventory management benefits greatly from data analytics. You can analyze customer habits, buying patterns, sales trends. You can use data analytics when determining the net realizable value of certain products exceed their cost. Analyzing search histories on their websites and examining sales order data can track and anticipate changes in the demand for products and product sales. Companies can also use data analytic tools to ensure that inventory on hand remains in optimal condition. Dashboards. Dashboards are a commonly employed tool for data analytics. They represent a collection of a variety of views of key measures that managers desire to monitor. If you have ever seen one, you know that a dashboard often consists of a number of worksheets. And because each worksheet is live, the manager can manipulate variables or views. We're going to look at a Tableau dashboard next. Using this dashboard, the manager can evaluate how well the company is meeting customer demand by evaluating fill rate. The manager can also see how efficiently the company is managing its inventory by evaluating inventory turnover and days in inventory. It can be evaluated by region, over time, and product line. So here's an example. So it's looking at the sales, the fill rate, inventory turnover ratio, days of inventory. Regions are there graphically. The fill rate by product line down in the lower left. the inventory turnover ratio over time. So there's a lot of things that a dashboard can show a manager all in one place, and it's all visual, or most of it's visual. What benefits does a dashboard such as this one provide to a manager for making decisions regarding inventory? Collection of views of key performance indicators all in one place. They're often dynamic, allowing some what-if analysis, and enables manager to zoom out or in to look at the whole company, divisions, regions, or particular product lines. So we'll look at inventory turnover question. Early 2027, Westmoreland Company switched to a just-in-time inventory system. Sales, revenue, cost of goods sold, and inventory amounts for 2026 and 2027 are shown. So we have a chart that has all that. Determine the inventory turnover in days in inventory for 2026 and 2027. Discuss the changes in the amount of inventory, the inventory turnover in days, and the amount of sales across the 2 years. So inventory turnover again, sales divided by, or cost of goods sold, divided by average inventory, and then days in inventory is 365 divided by the inventory turnover. So what does that look like? 2026, we have $1 million cost of goods sold divided by average inventory gives us turnover of 4. Days in inventory, 365 divided by 4, it's 91 days, 91.3. 2027, cost of goods sold divided by average inventory. So we have lower cost of goods sold, but drastically lower inventory, ending inventory. Our turnover increased to 7. Our days in inventory decreased to 52.1 days. So the significant decline in inventory as a result in just-in-time inventory proved its inventory turnover and days in inventory. However, its sales declined 10%. It's possible that this decline was caused by the dramatic reduction in the amount of inventory that was on hand, which increased the likelihood of stockouts. Okay, to determine the optimal inventory level, management must weigh the benefits of reduced inventory against the potential lost sales caused by stockouts. Okay, so just with the data given, we can assume that possibly, or make a decision or a analysis that possibly because of lower inventory we lost sales. We don't know that for sure, but that is one reason why the sales could go down. So maybe turnover of 7 and days in inventory of 52 or 2 are not the right measures, that we need to go somewhere between the two to both increase sales but then also keep lower inventories than what we had. So just an input, and some decisions will have to be made by this company and probably look at more data and do more analysis. That's it for Chapter 6. Again, if you have questions, please reach out, and we will see you soon.